The Intelligent Investor by Benjamin Graham is considered to be the best book on investing ever written by many people in the finance community. In the book, Graham shares a simple 7-step framework for deciding whether or not to buy a stock, and in this video, we're going to go over this framework in detail so you can apply it to your investing today. In The Intelligent Investor, Graham discusses two types of non-professional investors. The first is the enterprising investor, and this is someone who has the time and expertise to find investments that'll achieve better than average results. Enterprising investors are typically experienced investors who have deep knowledge about financial securities, and they also have the resources to find information that most of us wouldn't be able to get. On the other hand, we have the defensive investor, and this is the majority of people. Defensive investors care less about beating the average and more about investing safely and passively. Unlike enterprising investors, defensive investors don't want to spend a lot of time analyzing investments, nor do they care much about beating the market as long as they don't lose their money and their investments grow modestly. Most beginner investors fall in this category, and this framework is particularly aimed at the defensive investor. So if you're new to investing, pay close attention because this one's for you. The first criterion Graham says the intelligent defensive investor should look at is whether the company is large enough. As a defensive investor who seeks safe investments, you want to avoid riskier, volatile stocks. And the idea here is that defensive investors should avoid investing in companies that are too small, since the stock of smaller companies is usually subject to much more stock price swings in the public markets. Graham suggests that defensive investors should only invest in stocks that have over 100 million in annual sales. Next, Graham suggests that defensive investors should only invest in companies that have stable earnings. And by stable earnings, this means the company should have positive income every year for the past 10 years. If a company's stock passes this test, then according to Benjamin Graham, its earnings are stable enough for a defensive investor. Similar to earning stability, the next thing we should look out for is a proven track record of stable dividend payments. As defensive investors, we want to invest in companies that consistently pay us back for investing in them without us having to do any work. So Graham recommends that defensive investors should only invest in companies that have had at least 20 years of uninterrupted dividend payments. Next, you want to make sure that the earnings of the company are growing consistently. According to Graham, this means that the company's earnings per share needs to have grown at least 1/3 using 3-year averages for the beginning and ending 3 years. So for example, let's apply this test to a company with the following earnings per share over the past 10 years. If we take the average earnings per share for years 1 to 3, we get a 3-year average of $1.50 in earnings per share. For the last 3 years, years 8 to 10, we get a 3-year average of $3 in earnings per share. So if we calculate the growth rate, we see 50% in earnings growth using Graham's test, which is greater than 1/3, meaning it meets our criteria for consistent long-term earnings growth. Now, just to recap everything so far, our criteria for stock investments are at least $100 million in annual sales, positive earnings every year for the past 10 years, 20 straight years of uninterrupted dividend payments, and a 1/3 increase in per share earnings over the past 10 years using 3-year averages for the beginning and ending years. Now, the last 3 criteria in Graham's framework are a bit more advanced, so stick with me since I'm going to take these a bit slower and try to explain the terms in a way that's easy to understand. But before I do, if you're finding this video helpful so far, please do me a favor and toss it a like and subscribe to my channel so I can make more videos like this for you. Now, the next thing that Graham suggests to look for is a strong balance sheet. As a defensive investor, you want to invest in companies that can easily pay their debts and have little risk of going bankrupt. And the way we check that is by looking at the company's ability to pay off its debts coming up in both the short term and the long term. For short-term debts, we need to see at least a 2-to-1 current ratio. Current ratio is a metric we use to check a company's ability to pay off its debts that are coming up within a year. It represents the ratio of a company's current assets and current liabilities, or in other words, how many dollars they can make available to meet the debts that are due within the year. So if a company's current ratio is 2-to-1, that means it has $2 ready for every $1 of debt it needs to pay in the coming year, which is a very safe position to be in. For long-term debts, we need to see that the company's long-term debts are less than the company's working capital. This is just a fancy way of saying that the company should have enough assets on hand to cover all of its debts if it needed to. Working capital is the difference between a company's current assets and current liabilities. So the logic here is if a company pays off its short-term obligations with what it has readily available, then the company should still have enough on hand to pay off the rest of its debts. Next, Graham suggests that the price of the stock should not be too high relative to its earnings. Specifically, the current stock price should be no more than 15 times the average earnings per share over the last 3 years. At the end of the day, you never want to overpay for a stock. And with the stock market having speculators who hype up the price of popular stocks beyond what they're truly worth all the time, it can be hard to know when you're overpaying or not. So this criteria, as well as the next one, aim to prevent you from paying too much for what you're getting. Which brings us to Graham's final criteria, which is that the market price of the stock should not be too high relative to the book value of the company. In other words, you shouldn't pay much more for a company's stock than what the company's assets are truly worth. And specifically, Graham suggests that the current price shouldn't be more than 1.5 times the book value per share of the company. A company's book value is a way to represent how much money would be left over for the owners of the company if they sold all their company's assets and then paid off all the debts. It's kind of like a safety check. If the company you invest in went bankrupt and then sold off everything it had, you want to know that you'd at least get some of your initial investment back. For example, let's say you buy a company's stock and that company went bankrupt and sold off everything, then returned $10 per share to every shareholder. If you paid $100 per share of that company, then you'd be losing almost all of your investment and it'd be pretty hard to come back from that. But if you only paid $15 for a share, or 1.5 times the book value, then you would still lose money overall, but you would at least get a lot of your initial investment back. Now, Graham does note one caveat to the last two criteria, and that is if a stock's price to earnings ratio is well below 15, then you could justify a higher ratio on price to book value. Ultimately, as a rule of thumb, if you multiply the price to earnings ratio by the price to book value ratio of a stock, it should not be more than 22.5. This is the product of a price to earnings ratio of 15 and a price to book value ratio of 1.5. So for example, if the stock you're looking at has a price to earnings ratio of 9, but its price to book value ratio is 2.5, then the stock would still pass this criteria since 9 times 2.5 is 22.5. So to recap the intelligent defensive investor's checklist for selecting stocks, the company for any stock you should buy should be big enough to have over $100 million in sales, have stable profits with positive earnings over the past 10 years, have uninterrupted dividend payouts over the last 20 years, have consistent long-term earnings growth, have a strong enough balance sheet to where the current ratio is over 2 times and the working capital is greater than the company's long-term debts, have a price to earnings ratio under 15, and have a price to book value ratio of less than 1.5. Now, I know there are a few terms in there that are a bit more advanced, so definitely rewatch anything that you might not have understood the first time, or let me know in the comments if you have any clarifying questions. But all in all, this 7-step framework is a fantastic way to assure the stock investments you make are in safe companies you can hold for the long run. So with that, thanks so much for watching. If you enjoyed this video, don't forget to smash that like button and smash that subscribe button to see more videos like this one.